Welcome to the latest video in our Finance 101 series for people new to the workplace or financial planning. This video is one of a number focused on the subject of investment and looks at the main asset classes into which investments are generally categorized. Asset classes are used to group together investments that share similar characteristics and behaviors. However, not every characteristic of investments within a single asset class will be the same. For example, some may offer more potential to grow your money, whilst others may be designed to provide an income. Therefore, whilst asset classes are a useful way to categorize investments when building an investment portfolio, they are only a starting point for the more detailed research required to choose an investment. Typically, we break investments down into 5 main asset classes: equities, fixed interest, property, cash and cash equivalents, and alternatives. Let's look at these one at a time. Firstly, equities. These are often referred to as shares because the investor owns a share of the company in question. As the owner of a small portion of that business, you are entitled to your share of its profits, which are typically given to you as dividends. In addition, there is the possibility that the share price increases over time if the company becomes more successful, although it can also fall if things go less well. Next, we have fixed interest, the most common forms of which are government debt and corporate bonds. By investing in this way, you are lending money to the government or company in question. In return for the loan, you receive regular interest payments and the return of your money at the end of a fixed term, the risk being that the borrower defaults on their promise to pay. Moving on to property, this is an asset class with which we tend to be more familiar, at least residential property. However, the majority of property investment is made into commercial property. The attraction of property is that it provides a steady stream of rental income with the potential for capital growth if the value of the property increases. Such investments can be made directly through owning buildings or buying shares in a property company that itself owns a large number of different properties. Cash is an asset class with which we are all familiar through our experience of holding money on deposit with banks and building societies. By holding cash, you can dial down the risk in a portfolio, perhaps in times of stress, or to provide a source of ready funds with which to buy into opportunities when they arise. When we talk about cash equivalents, we mean things like fixed term deposits that are often held within money market funds. These are low risk too, but unlike your usual bank account, they can fluctuate in value a little during periods of market stress. This leaves us with alternative investments, which is a catch-all term for pretty much anything that doesn't fit into any one of the asset classes mentioned already. Examples include commodities, private equity, hedge funds, or collectibles. I hope that you have found this video useful. If you want to enhance your investment knowledge further, you may wish to watch the other videos in the series. Alternatively, should you wish to discuss anything covered in this one, I can be reached at the email shown on the screen. Thanks for listening.